Welcome to our High Rock monthly video. I'm Scott Tomlinson, and with me today is my colleague and partner and the founder of High Rock, Paul Tepsich, as well as High Rock's certified financial planning professional, Bianca Tomlinson. As you all know, we have three investment models from which we apportion an allocation percent to each client portfolio based specifically on our respective goals, the time horizon required to achieve those goals, and our tolerance for the risk and potential for volatility that we may have to endure in achieving our goals. Our wealth forecasts are intended to capture our long-term goals in a plan that then becomes the basis for our respective investing strategies. And we always stress the longer-term outlook for your time horizons, and although we do have to report your portfolio performance through each quarter of the year, we remind you that these reports are simply a snapshot in time. Just part of the journey that ultimately takes us to our end goals. On last month's video, we suggested that the bounce back in portfolio value so far in 2019 was likely not sustainable, and alas, that turned out to be true as May saw some significant downside to risk assets. We'll talk about that more in just a moment, but we always manage risk first, because why would we want to take more risk than is absolutely necessary to reach our goals? And by doing so, potentially put those goals in jeopardy. As you know, we focus on the return per unit of risk taken as a key metric in the management of our portfolios. So what happened in May? Well, the global stock market dropped by a little over 6%. It was led by US stocks, which are down close to 6.5%. Canadian stocks fared slightly better, down a little over 3%. And bond markets were positive, with the Canadian index ETF returning about 1.75%. So what does all that mean for your portfolio? Well, depending on the asset allocation in your investment strategy, which is individually tailored to your goals, and our tactical approach to whether we are fully invested in our models, it means that the less risk assets you have, the better your portfolio was able to withstand May's negative returns. Let's look at a simple example of one particular High Rock private client with a 50% weighting in the global equity model, which is at this time only about 50% fully invested, a 10% weight in the tactical model, and 40% weight in fixed income. Now, based on the three key benchmark indices weighted comparatively, a fully invested balanced portfolio of similar asset allocation had a negative total return of about 2% through the month of May. Our High Rock private client example had a total return of negative 1.7%. Now that's after fees, and our fees would amount to about 10 basis points, or one tenth of a percentage on a monthly basis. The benchmark indices have no fee consideration other than the embedded MERs in those ETFs. But as you can see, we were able to limit the downside with our tactical approach to having a bit more cash available in our global equity model. And that's cash that will be used for future purchases at lower prices. Of course, 1 month is a relative drop in the bucket for a long-term strategy. So let's look at the same client who has been with me for a long time and moved over to join High Rock in April of 2015. The combined annual average benchmark return with no fee considerations for this asset allocation was a little over 5.5% per year since the fall of 2012. Now, as for our private client, our High Rock private client, they have seen an average return of almost 6% per year, again, after including fees and costs. Now, importantly, their target return from their wealth forecast is 4.5% after fees, but before taxes. So we're nicely ahead of the long-term target with mitigated risk and less monthly volatility, which allows us all to sleep a little more soundly.
And Scott, the fees on that client are annual fees are roughly just over 1%, correct?
Correct. 1% is our management fee. The 15 basis points for Raymond James custodial services is the other part. So 1.15. Well, the next question then is a bit rhetorical because you all know that we are managing our portfolios with greater caution these days. But what is it that keeps us on our investing toes at the moment? Well, certainly the U.S. economy appears to be strong, with annualized growth of 3% and unemployment levels at long-term lows. And although the Canadian economy is struggling at 1.3% annual growth, employment numbers have been strong there as well. Well, yes, but it is not what is happening now as much as it is about what may be to come. So we want to look at what's leading the economies as opposed to what's lagging the economy. And employment is a lagging indicator. It usually grows after the economy starts to show strength. Wages and salaries are important because they give us an idea as to whether the consumer can spend in the future. In the US, wage growth has been stagnant at best for the last year and a half. So much for the corporate tax reduction trickling down to employees' wages and salaries. So we want to look more to leading indicators like manufacturing and the Purchasing Managers Index for a sign as to what the future might hold for the economy. Trade wars, as we all may have been hearing or reading about through the media, are not good for manufacturing and so not good for future economic growth. And we've seen some preliminary numbers on U.S. third or second quarter GDP coming in somewhere between 1 and 1.5% annualized. So that is giving us a signal that we're definitely heading to slower economic growth in the United States. And of course, what bond markets are telling us, with short-term yields being higher than long-term yields, it is a signal that economic growth is expected to slow. Today, U.S. Central Bank, U.S. Federal Reserve Chairman Powell talked about how the U.S. Fed is going to have to start to look at the possibility of lowering interest rates, and that is certainly something that they've been seeing in the yield curve as well, Paul, right?
Yeah, absolutely. They're certainly paying attention to the yield curve now, and as you can see, the dark green line is the end of May, and the yellow line above it, the dotted line, is the end of April, so that's just a one-month effect. And as we saw in the Canadian bond market performance, that was a huge rally in government bonds to lower yields, higher prices. And as you show there, that sort of 3 months or 6 months to 3-year, 4-year part of the curve really did go inverted. And an inversion typically, especially if it gravitates further up the curve in the 10 and 30-year part, does typically refer or infer a recession is pending.
And let's look at the Canadian situation as well. Despite a big jump in employment in April, wages are trending lower, and this will have implications for the already highly indebted Canadian consumer. And again, here, leading manufacturing data are also pointing at slower growth and the possibility of recession. And that's also indicative in the Canadian yield curve. Any comment there, Paul?
Well, it looks like the same picture in Canada. The U.S., Canada doesn't get a cold. If the U.S. gets the flu or a cold, Canada gets the same. So, and in fact, given the consumer leverage in Canada and the difference in our tax regime and regulatory regime, I would think the Canadian economy is in a much different and weaker situation than the U.S. economy.
And it would also appear that traders are now building in a Bank of Canada rate cut as much as they are a U.S. Federal Reserve rate cut sometime later in 2019. So I guess all of this is pointing in that direction. So for our clients who are concerned, who have floating rate debt and have had to pay a little more over the last year or so, there's likely to be some relief on the borrowing front if you have floating rate debt against your line of credit or your mortgage or anything like that.
Don't lock in.
There you go. And that's what we have to say for our June monthly video. Again, if anybody has any questions with regards to their particular circumstances, if we've raised any issues you want to talk about, your asset allocation strategy, of course, please always feel free to get in touch with us at any time. That is something that is always a conversation that we want to have with our clients at any time. It doesn't have to necessarily wait for your 6-month review. Anyway, that's all we have to say this week or this month. And we shall return again at in the beginning of July to review what happened in June and any further updates that we may have on financial markets. But until then, on behalf of Paul and Bianca, I would like to wish you all a hopefully good beginning to the summer. It's still cold in Toronto, but I gather you folks out in Vancouver have had some pretty decent weather, so please send it this way.